Hi everybody, Frank Finance here. Hope you're having a wonderful day. Today we're doing a stock analysis on AMC, ticker symbol AMC. For today's agenda on AMC, I'm going to give my price target. We're going to look at shares outstanding. We're going to look at its market cap history, look at the share price history. We're going to look at the fundamentals of AMC, which is very critical here. And then finally, I'll give my thoughts on AMC as an investment. If you're new to my channel, I do videos on investing and personal finance. So if you like this kind of content, please consider subscribing. Also hit that thumbs up button. It helps me a lot with the algorithm. Now back to the content. My price target for AMC is sitting around $2.62 a share, indicating about an 80% overvaluation at its current values at $13. Now, this price target is really optimistic because it really hinges on revenues returning back to 2019 levels in 2021. And we know that's not going to happen based off their last earnings call. Now, all the things that have happened in the last year since COVID have happened, there's been floods into different names, and AMC has been one of those. So we could see some market exuberance, especially within that, and everyone thinks that AMC is going to the moon. But I'm gonna go through why AMC is not going to the moon in this stock analysis. So stick around and find out why. Now, over the course of the pandemic from 2020 up to 2021, movie theaters have had a hard time getting people to come into the movies to watch their theaters, whether they've been shut down by law or just the fact that content creators haven't been releasing and have halted production on some of their films. Now, as we get through the remainder of 2021, I expect that to kind of get back to a normal pace as movie theaters seem to be opening up. But how did they get through 2021 or 2020, 2021? Well, they did issue some new debt, and some of that debt got converted over into shares, and they also issued new shares. Now, all that new share issuance as well as conversion of debt into share prices, that has caused AMC to issue a total of 330 million new shares in the course of 1 year, equal to about 285% more shares than they had in the previous. Now, this is going to be very important to the valuation of stock. As we know, valuation is the number of shares outstanding, or I shouldn't say valuation, the market cap is going to be that 450 million shares times the new share price, whatever they're currently selling at. So please keep that in mind, why shares outstanding is important. AMC has huge overhead and they have to pay for it somehow. So the reason why their shares outstanding continues to go up is because they need to pay for operations and overhead. Now, what that looks like is they just keep issuing shares like crazy, and that's not good for current shareholders because it just dilutes the value that they have out of per share value. Now that we know that shares outstanding has increased, let's look at what the current value of the company is in terms of market cap. So if we look at the market cap history over the last 7 years, we can see between 2014 and 2021, it's varied between 1.5 billion, went all the way down into 300 during the pandemic. But pre-pandemic, it was trading at 740 million market cap. And then currently, the market cap is at 5.19 billion, and that's, again, historically very high, as well as high compared to the number of shares outstanding. So currently at a market cap of 5.19 billion compared to 740 million pre-pandemic, that means that AMC is currently trading at 7 times higher valuation than it was pre-pandemic. So you really need to check yourself and ask yourself the question, is AMC worth 7 times more than it was before all the new share issuance, all the new debt that was brought on, as well as the current cash flows and the current revenue bringing into the business is substantially lower than what it was pre-pandemic. Hey, you're still here. If you like this video, please hit that thumbs up button. It helps me out a lot with the YouTube algorithm. Now back to the content. So let's look at stock price history real quick. So between 2014 and 2021. So in 2014, they were trading at $20 a share, and they traded fairly up until the $30 range up until 2017. and when they issued new shares, and their stock price dipped all the way to the $15 range. Now they kind of bounced up, really traded sideways all the way up until the beginning of 2019 when they started dropping into 2020, and the stock continued to drop until they hit a pre-pandemic low around $7.46, which again for the remainder of that year it was the low. They did have a few spikes in their stock price, and currently they're trading at $12.98 a share. I'll throw up here just a reminder of when those shares were issued as a comparison to market cap, as well as shares outstanding versus stock price, and to see where those levels are because they do correlate. All right, so now let's look at the financials of AMC between 2014 and 2019. I'm going to have the 2020 numbers on there, but I'm not going to go over them because they were trash. And so let's be optimistic in this analysis, even for the sake of the people who are going to be very doubtful of what I'm talking about here. So if we look at the revenue between 2014, we saw that it went from $2.6 billion up to $5.4 billion. So they had nice growth of about 100% between those years. Now you saw the big bump between 2016 and 2017. So that's really good to see for them. But you can also see between that 2017 and 2018 when they saw no growth, that's also a time when they saw their stock price decline in a combination with the new share issuance. If we look at their gross profit, that has definitely been in line. Their gross margin has relatively stayed the same, basically flat. That's good to see. But if we look at their EBITDA, that has actually declined. So even with the $2.5 billion in total top line revenue growth, they still saw a decline in their EBITDA margin, which is bad to see. And same thing with their net income. Even with net income growing by almost $2.5 billion, they actually saw a net income loss of $149 million in December of 2019. And even if you look at their net income between 2014 and 2019, you got $64 million, $104 million, $112 million, $110 million. So just doing let's say pick the biggest number on here, $112 million in December of 2016. If we go off of their current market cap of let's say $5 billion, they are 50 times net income in valuation. So that's not a good valuation, just even based off of their best year in terms of net income. So moving on to another fundamentals, let's look at their free cash flow. So cash from operations minus their capital expenditures. So for 2019, they had $579 million. Cash from operations minus their capital expenditures of $530. You get $49 million in free cash flow. So free cash flow is a really good indicator of how much money they're actually bringing in. If you look at their price to free cash flow for their current stock price, their current valuation versus their 2019 free cash flow, that means they're valued at 102 times what they basically the price to free cash flow is 102x, which is just absolutely insane. You want to see something high end between 15 and 20 for most stocks. So way overvalued on that metric. So when we look at AMC, my suggestion is just stay away, run away, get away as fast as you can. I don't recommend doing puts or playing this short because we've seen time and time again, these markets have acted very irrationally, especially on names that don't have the fundamentals. And even if you're right, you could get burned. So my suggestion is, even if you believe they're negative, like I do, don't get into it on a short position. Don't be a bag holder. Even, for those who are buying for the long haul, please just get out. Don't be a bag holder. Run away as fast as you can. Again, I've told you that shares outstanding have increased by 285%. At their current market cap, which is 7 times higher than what it was pre-pandemic. That's absolutely ludicrous. They have a sizable debt load of $11.3 billion, and they can't even increase their debt load from here, or they could, but they're going to get really bad interest rates. And the reason why they can't increase it very much, and the reason why they're going to the equities market by issuing new shares is because they get such a bad interest rate, and it costs them more money just to go through the debt route. And also they have such a high debt load right now, their interest rate, their interest payments are so high as comparison of their actual revenue. Now, they're not having any growth, so there's no justification on why their market cap should be higher, why their valuation should be so skewed to what it was pre-pandemic. If we look at current price to 2019 free cash flow, that ratio is 102x. If we look at their shares, they're so overvalued based off shares outstanding, their current market cap, their stock price, as well as their current fundamentals. Very, very bad. And what all that comes down to is, again, my stock price for this is somewhere around $2.62 a share. That's about an 80% overvaluation from where it's currently trading around $13 a share. So again, if you're in this name, please get out of it. Don't be a bag holder. If you've made money on it, get out while you're in the green. Again, nothing bad about AMC. I don't have any problems with AMC as a company. I'm just saying from a pure investing standpoint, there's no fundamentals that support the current valuation of the stock. There is a number that makes sense, and that's what that $2.60 something cents is about. But at its current valuation, there's no reason for people to be buying the name, especially in long positions. That is just doesn't make any sense. If you like this type of content, please consider subscribing. Also hit that thumbs up button. It helps me out a ton with the YouTube algorithm. Thank you so much for watching this video. Frank Finance, out.